Most traders focus on the wrong thing. They think that risk management, discipline, and their own psychology is what is going to make them a profitable trader. But the truth is that none of these things actually matter unless you have something called positive expected value in your trading strategies. Expected value, or EV, is the most important concept in all of trading. If you have it, you should make money in the long run. And if you don't have it, well then no matter what you do, you're going to lose money on average in the end. So today I'm going to teach you exactly what expected value is. I'm going to show you how companies outside of trading use this as well to make money, companies such as casinos. And then of course, I'm going to show you how to use the things you learn in this video to become a better trader. So the idea of expected value is to answer one question and one question only. If I take this trade over and over again, am I supposed to make money on average? It's not just a trading concept, this is a statistics and game theory concept. Poker players, casinos, insurance companies, lots of different businesses use this theoretical concept to decide if they should be taking a certain action or not. And the best part is, there's actually a formula for expected value. Here it is. Expected value is equal to the probability of winning multiplied by how much you make if you win. And then you subtract probability of you losing multiplied by how much you lose if you lose. If you run this calculation and you get a positive number, then that means you have positive expected value. If you run the calculation and you get a negative number, that means whatever action you're taking on average has negative expectancy. Let's take a look at an example outside of the world of trading to really lock in this concept. We're gonna look at a roulette table in a casino. Everyone knows that casinos make money on average because they have this edge. And in this video, we're going to call that edge positive expected value. So when we look at the game of roulette, here's how it's basically set up. Let's say that every time a gambler sits down at the roulette table, they bet $10. And if they win, they're going to earn $10. And if they lose, they're going to lose $10. So the bet size is 10, the payoff is 10, and the risk is 10. Now, because of the zeros on the roulette table, the odds of winning for the gambler are not actually 50-50. Instead, they have a 48% chance of winning and a 52% chance of losing. Or if we look at it from the casino's perspective, they have a 52% chance of winning, or a 2% advantage. Now that we know all these numbers, we can actually plug them into our expected value formula, and we can run a calculation here to figure out if the casino is supposed to make money on average or not. So we look at the expected value formula, and we know that the probability of winning for the casino is 52%, so we plug that in. And we know that if they win, they're gonna make $10. And then we have to look at what they're gonna lose. So we subtract 48%, the odds of losing, multiplied by $10, how much they lose when they lose. If we run this calculation, what we will see is that the expected value for every spin on the roulette table for the casino is 40 cents per game. That means on every $10 bet, the casino is expected to make a profit of about 40 cents. Now, of course, they don't actually make 40 cents on any given hand here because they either win 10 or lose 10. So if they played only one game, they're either up 10 or down 10. But if they played thousands and thousands of games, what you would see if you took the total return that they made and divided it by the number of games, you would see that after enough games, they would come out to a net return of 40 cents per game played. And that is what expected value is designed to tell us. Now, imagine a casino had a game that had negative expected value. What do you think they would do? They would immediately shut that game down. Why would they allow you to play a game that has negative expected value? They are not a charity. They are not in the business of giving money to people coming in to gamble. They are in the business of extracting money from them. But of course, the reason we play these games is because it's fun and there's variance and you can make money because you're not playing thousands of hands each time you're in the casino. So that is the allure that brings the gambler into the casino. But the casino knows that across all the tables that are being played, all the thousands of people in there gambling at any given time, they are pretty much guaranteed to make money every single day. Now, if you want to start trading with the same statistical edge that professional traders do, using the same philosophy that casinos do to make money, for example, click the link in the description of this video and take a free trial with Predicting Alpha. We are the quantitative co-pilot that makes it simple to run data-driven trading strategies in the options space. And if you take that free trial, you can come in and steal my 5 systematic strategies and then stick around if you want to use the tools to run them. You're going to learn strategies that are actually built on positive expected value. Now, here's the hard truth about expected value and concepts like this. If you don't have positive expected value, no amount of risk management is going to make you profitable. Roulette players can't size their bets a certain way and gain an advantage over the casino. No amount of focus or psychology is going to make them profitable. And it's because the game itself is literally rigged against them. The only reason a casino does things like have a minimum bet and a maximum bet on a table, the reason they have multiple tables running at the same time so they can play many games, the reason they can spread their risk and manage their risk and make a good return is because they know that fundamentally all the games that they allow you to play in the casino have positive expected value for them. In short, they are running profitable games. And trading is absolutely no different. You need to be running strategies that have positive expected value before you start worrying about things like psychology and risk management. Are we playing a winning game is the first and most important question that we need to ask when looking at the strategies we implement in our portfolio. Good traders think pretty much exactly like a casino or an insurance company. We are running a business in a sense. They look for games where they're getting paid to take the other side of someone else's trade. In options, games like this usually show up when someone is looking to offload a risk that they don't want on their books and they are willing to overpay to do so. Two examples of situations like this is when you go out and you sell options on ETFs. And another situation would be when you go and sell options around earnings events, two of the strategies that we actually focus heavily on in the Predicting Alpha education and platform. In both cases, you're stepping in to take on risk that other people are trying to remove from their books. And then you are making money because you're getting paid more than how much risk is actually going to materialize. If you want to learn these strategies for free, you can literally take the free trial in the description of this video and go through the masterclass there. It'll cover both of them in detail, giving you all the evidence, the research, everything you need to go out and see these things for yourself in the market. So click the link and sign up. Now, even if you find a strategy that has positive expected value, something else that you need to be really aware of is that most of the time, these edges are going to be small but persistent. A lot of times they're pretty obvious, actually. You know, the idea that a risk premium exists around earnings events doesn't really take a genius to figure that one out. The hard part actually comes down to monetizing this risk premium. Going out there, managing your costs, having good execution, and actually running the strategy systematically are the challenges that will often be between people who are successful with the strategies and ones who are not. And this is where having good tools, good support, and good community really come into play when you're trying to make money. No matter what strategy you run, positive expected value or not, there's going to be upswings and downswings. And in strategies that have positive EV, when you have a downstring, it's the idea of positive expected value that really allows you to survive those downswings and stay in the game long enough to see the recovery and upwards trend. Now, when it comes to your options trades, people will be sitting there maybe after this video saying, okay, I'm going to calculate the expected value of every single trade that I take. But this is not exactly how I'd recommend thinking about options as you go out and start looking at the market. And the reason for this is that the expected value equation works for situations that have a binary outcome. You either win or you lose. You either win a certain amount or you lose a certain amount. But in options, that is not how the payoff works. There is a distribution of potential returns and risks. You could win a little bit, you could win a lot, you could lose a lot, you could lose a little bit. And for that reason, instead of trying to directly apply the expected value formula to every trade you take, you just need to take on the mentality of expected value and ask yourself, am I placing a trade that should theoretically be positive expected value? Now, there are ways that you can go and try to calculate your expected return on a trade by coming up with your own volatility forecast, things like that, or observing a large number of trades and seeing the average return. But these are different ways of going about it compared to the expected value formula, but it's all with the same mentality of, am I making money on average by taking these trades? Expected value is the filter that separates the gamblers from the professionals. When you have positive expected value, you're going to make money on average. And if you don't have it, you should probably switch games. If you like this video and you want more free option selling education, good trading education, click the subscribe button. I release videos like this multiple times a week. Happy trading, everyone, and we'll see you in the next one.